Hello and welcome back to Game of Trades, your #1 channel for videos on the stock market and cryptocurrencies. This video is going to be focused on the S&P 500 that has been making some pretty violent moves over the past few trading sessions. These are some pretty volatile moves. We had a 4% correction here in just a couple of trading sessions. Many people are talking about the fact that this is looking a lot like a big topping pattern with divergences, a fading momentum, and one final thrust to the all-time high before we start a major move down. This is, of course, all coming as we're having the Federal Reserve talk about accelerating tapering, talking about hiking rates in 2022. All of that is creating uncertainty. All of that is raising concerns amongst investors on whether or not the U.S. equity market can hold up despite the Federal Reserve no longer having a dovish tone and actually switching more to a hawkish tone. We're going to be talking about all that in this video. Is this just the beginning of a much larger move down, or are we actually seeing an opportunity here to step in and buy and take advantage of the rest of the bull run? If you're interested in following the stock market with us, if you're interested in finding opportunities in the financial markets with us, make sure to click on that subscribe button. Also, click on the notification bell if you want to have these updates in real time and not be late to the party. And now, without further ado, let's get right into it. Alright, so I just want to begin by doing a quick recap of our recent videos on the S&P 500, just to take a look at how we've been trading this period of volatility on the S&P 500. A lot of people get scared when they see the market making these types of wild moves up and down, and that's understandable because a large majority of traders are going to get cut to pieces in this type of volatility. Now, back on November 24th, we talked about this nice topping pattern, price making a higher high, divergence on the RSI. We had signs of complacency on a few different sentiment indicators, volatility that was slowly starting to rise despite the market not crashing. And so that helped us anticipate part of the move down that we had here towards the end of November. Then on the 3rd of December, we talked about this bullish divergence that was developing, right? Notice bearish divergence as price makes a higher high, momentum makes a lower high, but this was bullish divergence, and we talked about our S&P 500 rating being a weak buy here. So that helped us stay bullish despite those big sell-offs that we had right here and step in and buy the right moment. And in this video, we're going to talk about what this weak buy that we talked about right here is turning into as we failed this retest of the all-time high. We extended those divergences, right? Look at this bearish divergence with price making a higher high, RSI making a lower high. Is this still a buying opportunity as we come closer to this line of support at this price channel support? Now, I don't often go back on the convictions that we've had throughout the past, but I wanted to do this recap for you to know which side of the trade we've been on. We've generally been bullish, looking for buying opportunities with a lot of caution when we get these bearish signals and we get signs of greed. Now, do not get me wrong. We do not have a crystal ball. We've been wrong before. No one is immune to that. But I will say I am pretty proud of the way we've been able to navigate this wild environment. And I'd also like to say a big thank you to you guys, because it's through your feedback, through your criticism that we have on the YouTube comments and from our community on gameoftrades.net that I think that we're able to have that 2020 vision on the stock market, because we're always in contact with people that have polar opposite opinions as we do. You know, although that can be frustrating at times and it can be tough to put up with, I don't think there's anything that can bring more wealth to our reflection on our strategy than that. So again, if you enjoy our videos, you like the way we present our content, or you have any feedback, make sure to smash that like button and comment down below anything you'd like to share. So now let's talk about what the market is doing here. I want to jump in to this chart here of the fear and greed model of the S&P 500. This is a sentiment indicator, right? It's the same thing as the CNN fear and greed model. We just have data going a lot further back, and it's just one of the indicators we like to use to give us a bias on the stock market. right? We want to be entering when there's fear in the market. We want to be entering when other people are panicking, when other people are letting their emotions get the better of them. That's when we want to be making polar opposite trades. And once you understand that, you start to get in this beautiful dance with the stock market, these beautiful swings. We had a lot of fear back in October. That's when we started to get really bullish on the market. We got this nice rally. The market switched to a lot of greed back in November. That helped us take more of a bearish stance. We've had a little bit of volatility since that peak there, and now the market is starting to get fearful again. So just from this first indicator we're looking at, we should start to have a little bit more of a bullish bias here, and depending on other factors, perhaps a very strong bullish bias. Now, this is not rocket science. This is a big part of what it takes to be successful in the market, just not letting your emotions take the better of you. That's why you need to be watching sentiment indicators to keep it all in perspective, keep it all in context. And if you want to take it one step further, you can actually take advantage of other people's emotions. That's exactly what we do on gameoftrades.net. That's a big part of our service, is to try and keep our members away from emotional decisions and reminding them that the entire goal of what we're doing is to actually take advantage of emotions, not being enslaved by them. And once you get that, once you follow that and you have guidance with it, that can already step up your game big time. So if you're interested in following our trades, following our take on the market, make sure to subscribe. Make sure to take a look at our free trial, take a look at our recent articles, and also our trading watch list, because we do have quite a few big trades right now on the watch list. And from what I'm seeing on the market right now, I think they're going to be playing out in a big way pretty soon. Now let's take a look at another similar indicator, right? It's not exactly sentiment, it's the volatility of the S&P 500. Now again, just not rocket science. Volatility rises when you have corrections on the stock market, right? It's typical. Big spike in volatility, big drop on the S&P 500. Rinse, wash, repeat. And when you have a decline in the volatility, that's usually accompanied with a nice rally. Now we did have a breakout here. Look at these trend lines that I had on the VIX. We had this nice, beautiful resistance line throughout the entire 2020 and 2021 rally, where we saw a decline in volatility as stocks went higher. And now we're breaking out of that resistance. So instinctively, as I see that, it tells me maybe we get a little bit more volatility in the next few trading sessions. Maybe we retest that line, but that's just my personal bias coming into the game. If you want to be completely objective on this, we've had volatility rise considerably. We're in a pretty volatile moment on the S&P 500, and that leaves a lot of space for volatility to come back down, as it did here, as it did here, as it did here. If we look at those moments on the S&P 500, those each correspond to pretty consequent rallies, right? You don't want to be on the wrong side of that trade. So that does strengthen the bullish case on the S&P 500. But now let's talk a little bit macro. I know I'm going to get a lot of comments. All right, we're looking at specific indicators, sentiment, volatility, but all of that is useful for buy the dip entries, right? And, that's been very successful over the past few months. Any trader who's been following these strategies that we've been talking about has been immensely successful. But if the macro environment changes, that can set up the stage for a much larger correction despite all those temporary bullish signals that we're getting. Now, I think the macro environment is still very much favorable to the S&P 500. If we take a look at bonds, right? Let's take a look at treasury bond prices. This is a pretty complicated chart, lots of levels to look at, but let's keep it simple. Just look at where bonds have been heading throughout the past few months. They've been trending up slightly higher, and typically that's a bad sign for stocks, right? As bonds rise, right? We've covered that many times, but as bonds rise, stocks tend to go down. Bonds come down, stocks rise, and that just happens over and over again. They have a almost perfect inverse relationship, and so we absolutely need to look at what is happening on the bond market if we want to know where the S&P 500 is going. So do we think that bonds are going to start skyrocketing here, or do we think that we're about to see a major correction on the bond market? Now, if you think about what bonds are, the only possible bullish case behind bonds are that they are I OUs, right? They are yields. They will get you passive income. If you buy a bond, you will have interest on that bond. So let's take a look at what that interest is. Currently, the bond yield on the 30-year Treasury is at 1.8%. But if we take a look at inflation, it's at 6.88%. So that tells me that US Treasury yields are deeply negative. Okay, so maybe inflation is going to start coming down, right? Maybe that's the bullish case behind owning Treasury bonds. The problem with that is that we had a massive amount of stimulus in 2020, right? Look at the M2 growth rate in 2020. That was around 20 to 25%. If you look at history, inflation only shows up after a while when you have an M2 growth rate, right? You have a big surge in M2, and then just a couple of years later, you have inflation start to rise and it peaks 3 to 4 years later. We had that in 1970s. We had that in 1976. Inflation peaked a few years later. And that's exactly what's happening right now. We had a peak in M2, and now we're seeing inflation rise. And you can see M2 has peaked, but inflation's still going up. And we can expect that to continue going up unless they begin to tighten monetary policy, because that can slow down demand and it can reduce inflation. The problem is that they haven't even begun tightening. If we take a look at the federal fund rate, it's still at 0. They're still doing quantitative easing. They're doing a little bit of tapering, but even tapering is still easy policy. So I think in that environment, we're going to see selling pressure on Treasury bonds, right? Maybe we get a little bit more upside before we top, but I think ultimately the macro environment is going to drive bonds lower. And to me, that means that the stock market is still in a bull run, because when bonds fall, it's historically a great moment to be in stocks. Bull runs in the stock market are characterized by falling bond prices. Now, that's about all I wanted to cover in this video. I hope you guys enjoyed. If you did, make sure to click on that like button. Now, in the meantime, I wish you good luck on your trading and see you next time.